I want to talk about something else money related. We talked about these people that allegedly are going broke. We talked about the submarine. We talked about how it is that you need to protect yourself financially, especially when it comes to the advice that these dudes are giving you with regard to becoming a single father. But I want to talk about something different because it always comes back down to the money. I want to talk about the King. You know, one thing about Burger King, this mascot has always creeped me out. This mascot has always creeped me out, and I don't know why, but it just always just reminded me of like the Scream mask or something like that, right? But I want to get into Burger King because Burger King is a part of a bigger conglomerate of companies, and I want to break down the financials and the $400 million investment that they're making into this brand in order to compete with the likes of McDonald's, Wendy's, and even Chick-fil-A. Make sure y'all hit a like for the YouTube algorithm, subscribe to the channel, and turn on your notifications. This is the Millionaire Morning Show, which is the greatest show on the face of the earth. Let's get into the show.
With its almost 20,000 global chains, Burger King has been a major force in the fast food industry for nearly 70 years. BK represents a dominant $25.5 billion of its parent company RBI's, nearly $40 billion in total sales in 2022. Since going public in 2014, share prices for RBI jumped from nearly $40 a share to over $76 a share in June 2023. But as of late, Burger King has dropped in its standings against rivals. Slumping sales come from complex menu items, outdated restaurants, and slow operations. While still the third largest burger chain, BK ranks 7th in the fast food category behind McDonald's, Chick-fil-A, Taco Bell, and Wendy's in 2022.
Now, a lot of people are not familiar with this, and they're not familiar with everything from Yum Brands to how McDonald's runs its operations, even over in the Chick-fil-A, right? They don't understand franchising agreements. They don't understand why it's important for them to reinvest in this company. They also don't understand the difference between the strategies in the companies and how it is that they're forcing the franchisees to abide by what it is that they have as far as the standards for the companies. So, for example, if you really understand McDonald's and you studied it, and even if you even watched the movie with Ray Kroc, and then you read the book in order to break down how it is that they run their franchise, I've even had the opportunity to attend Hamburger University over in Illinois. Now, how is Anton able to get an invite over to Hamburger University? Not because I was necessarily looking to become a franchisee, but because when I first met my wife, even at the early age of 13, 14, 15 years old, my wife was working at McDonald's, all the way to the point to where she had grown to become a district manager. She had graduated from being a store manager to a district manager. Rita was on her way to becoming a franchisee and owner-operator of a McDonald's. But Anton said, nah, boo. I do not want you out here working for the man. You're going to be working for your daddy. And it all worked out after that. But in order to become a district manager and then graduate into becoming an owner-operator, you have to go to Hamburger University. Hamburger University is with what franchisees have to attend so they can better understand what the expectations are and how they run things as an owner-operator at McDonald's. Okay? So, if you guys don't understand the strategy behind how these operations are ran, depending on the franchise that you choose to get into, I am going to have a conversation with you today. One of the reasons why I was able to lean into Rita in order to make certain investments as a silent investor, and I go through her and I vet her opinion in order to determine whether I should make an investment in this place or this place, because she has a vast array of knowledge. And just because she's fit, feminine, and friendly does not mean that I don't utilize the best of her to extract what I need to make the best business decisions possible. Marriage is a business first, ladies and gentlemen. All right, but let's continue.
Wendy's most recently overtook Burger King in 2020 after it launched breakfast.
Earnings for Burger King have seen sales growth flatten, franchises filing for bankruptcies, and a new leadership overhaul.
Like any business that's been around for 7 decades, you'll have some ups and downs. That's part of the normal course of business. And we did have a few of those over the last few years.
But in 2022, the company announced its biggest shakeup yet.
Burger King announcing a $400 million investment in revitalizing stores, advertising, and digital in an effort to try and accelerate growth.
It's really a 360-degree plan they're pursuing here, with the management team prioritizing operations, prioritizing brand management, things that are just broadly neglected between 2018 and 2021.
So the question now.
Here's my question for y'all. Who knows what RBI is? Is anybody familiar with RBI? Is anybody familiar with RBI? RBI is the umbrella company that then controls multiple different brands, which include Burger King. I'll ask you another question. Who out here is familiar with Yum Brands? Anybody know what Yum Brands is? KFC, Taco Bell. They have a huge presence overseas. It is the umbrella, it is the parent, not the umbrella company. It is the parent company that then oversees multiple different restaurant brands within their portfolio, and they take certain strategies and then they combine certain ways in which they call it efficiencies. Basically, you don't have to use two different HR departments. You don't have to use multiple different strategies when it comes to food. You can combine resources, you can cut costs, but you can run multiple different brands as a result of it, right? All of these companies have to prioritize which restaurant brand is the priority for them to then allocate their resources to rejuvenate sales, to get more investors, to get more franchisees, to make people happy, to make the shareholders happy, so on and so forth, right? And so when you start to go through and you understand a lot of these different investment strategies with regard to who's investing in what, you then can source through and understand how it is that they're able to compete against bigger brands, right? How can they allocate their resources more effectively? McDonald's is just McDonald's. Chick-fil-A is just Chick-fil-A. Chick-fil-A's franchising strategy, because they want to control more things and keep it in-house, does not allow for you to actually own a Chick-fil-A location, right? You can pay $10,000 to become an owner-operator, and you have to be a working manager, meaning that you have to pay the money. If they select you, then you learn how it is to run a franchise, and then they kind of sort of guarantee you a six-figure salary to be an owner-operator or a operating manager of that particular Chick-fil-A, but you don't own it. They will forever own it. And then more importantly, you will not own any other multiple different restaurants. So they vet out the person that they want to actually run that location because they want to control everything in-house. Whereas McDonald's has a completely different strategy, right? McDonald's strategy is way different. McDonald's is focused on running up as much profits as they can, to make sure that you don't have another McDonald's within a certain distance or radius within that one. That's A. B, the way that they control how it is that you're running things as a franchise operator or owner operator is that they own the real estate by which you have to build the location on top of. So because they own the real estate, you then are basically renting out a location, but they're guaranteeing you to make a certain amount of money potentially. But in order to get you to comply with whatever the franchise rules are, they can snatch away your franchise at any point because they own the real estate by which your restaurant stands on. McDonald's is just as much in the real estate business as they are in the burger business. Now, how do these restaurants make money? We're going to get there shortly.
Now, can $400 million and a couple Domino's executives bring back Burger King to its former heights, or is it too late? In September 2022, one of the biggest quick-service restaurant brands in the world, Restaurant Brands International, announced its Reclaim the Flame plan to revamp the North American Burger King chains.
Investors started getting concerned about sales slipping around late 2020, early 2021. You were also hearing the Restaurant Brands executives talk about it openly on the analyst calls.
Fresh leadership is at the top of BK's new initiative. Patrick Doyle and Tom Curtis, two former Domino's executives that launched the pizza chain's turnaround to take the #1 pizza spot in the world.
So basically, they paid them an egregious amount of money because they were able to turn around Domino's and make it a dominant brand on the brink of having problems and competing with Pizza Hut and everything else. And then they brought those executives into Burger King in order to revitalize the brand, looking for that same magic. That's basically what they're telling you right now.
Some of the great things that happened at Domino's were in recent history. From 2010, to 2020, the brand engineered an amazing turnaround. And we always had an objective there of something great. But what was really great was the journey, not actually the destination. And that's part of the reason why I came to Burger King.
Curtis's colleague Patrick Doyle invested about $30 million of his own money into the plan.
Patrick is very much like a franchisee now. He has his own capital invested in RBI. And he absolutely wants to make it successful and make sure it's successful.
He got skin in the game.
Not only just so he's been recognized as done a good job, but also because he's heavily invested in it and his livelihood's there too.
The $400 million will be dedicated to all North American businesses in 3 categories: $250 million to remodel about 800 locations, and about $150 million into advertising and digital investments. Another part of that plan? Closing about 400 underperforming stores.
So this is the strategy as I interpret it. And I'm going to be reading Super Chat shortly. Thank you, Jeremy H. This is a strategy as I interpret it, okay? $250 million into renovations because nobody wants to go to old stores. You have to operate these stores more efficiently. And also, let me tell you this, right? Because McDonald's, as I understand it, kind of incentivizes or advocates for their owner operators to continue to keep up with the times, to reinvest back into their business, and even do, construction as far as now that they've done the user experience on how it is that they can make the drive-thrus more efficient, how they can make the restaurants more modern, get rid of all of those stupid balls that the playpens and everything like that. You still gonna have a couple locations with that. But McDonald's is adamant about pushing their owners and operators to continue to reinvest back into the business, right? And so part of Burger King's strategy is that they want to allocate $250 million to renovate at least 800 stores because they want to modernize it. They want them to compete as far as the look and feel and also operate more efficiently and possibly save money. Another part of that, after they monetize it or modernize it, is they want to have advertising and digital spending to then bring visibility to the brand in order to rebrand what Burger King is. They probably need to start by getting rid of the King at the bottom of the screen or whatever like that. And then they want to close 400 underperforming stores. A lot of times, a lot of these franchises, Burger King, McDonald's, Wendy's, and whatever, there's a separation. There's owner-operated stores, and then there's corporate stores, right? Owner-operated stores gives a person a more vested interest in seeing it successful. A corporate store, a lot of times, will then be there, and then at the same time, they're trying to get somebody to take over it as a franchisee, all right? So there's multiple different strategies that come along with how it is that they make money and extract resources in the ways in which these corporations generate revenue, right? They prefer not to have to run a store. They prefer for you to run the store so that they can generate the majority of their revenue by A, a percentage of the sales, and then B, sending you over the product that you have to sell from them to the customer, okay? These are the ways in which they make the majority of their monies and resources, and franchising and the fees that's associated with it. That's the way that the big brands make their money, and then you make your money as a result of being attached to it and then executing the strategy that they already put together, which is one of the reasons why you pay the fee for it, okay? So again, the goal, $250 million in renovations, $150 million in advertising, and then closing underperforming stores. All right?
This is a seminal moment in time for us to figure out which restaurants have long-term viability. There's a few out there that don't, and we need to take those off of our owners' backs so that they don't have to bear the losses and can put that money back into growing their asset base and their restaurants that they do own.
We are seeing a heightened amount of closures this year. That's going to really help set the foundation for net restaurant growth to get better. Fewer closures in 2024.
In 2022, profits at Burger King stores were down nearly 20% from 2018.
A lot of times the way that shareholders and analysts analyze the health of a company is to look at the year-over-year sales. It's not entirely just based off of the net profit, right? Because they want to see growth. They want to see you being able to compete. They want to see expansion. They want to see where you can continue to bring the company to higher profits or whatever like that, right? It's not just your current year-to-year sales. It's not even just profitability. It's all about growth. they'll even forego some of the profitability if they can continue to see the growth in the company. Amazon is an example of this. Amazon didn't make money for a very, very long time. Amazon is not even a dividend company. I bet y'all didn't even know that. It's not a dividend company. They don't give money back to the shareholders in the form of a quarterly dividend. Amazon gives value to the shareholders by ensuring that they continue to prop up the value of the stock itself. Berkshire Hathaway. A lot of you guys are not familiar with Berkshire Hathaway. Berkshire Hathaway is one of the companies in which it costs the most to be able to buy one share of their stock. As a matter of fact, let me look up what the share price is of Berkshire Hathaway. Give me 1 second. Berkshire Hathaway Class A stock is currently trading at $513,308 per share. Let me say that again. $500,000 per share of Berkshire Hathaway stock. They do not return value back to the shareholder. They do not return value back to the shareholder in the form of a dividend. They do not take profitability back to back from the company and then pour it back into the shareholders in the form of a dividend or a payment. They just reinvest it back into the company, and the value that you have is based off of how high their stock is going to go. Okay? $500,000 per share. A lot of you guys had no clue of that, I bet. Let's continue.
Their store level cash flow was about $140,000 in 2022. That compares to 2018's $175,000. So 20% below the 2018 levels. We think in 2024 they will get there, if not by the end of this year, just given the success that they're seeing. And longer term, that's obviously a level they need to improve to remain competitive with brands like Taco Bell and McDonald's that see higher store level cash flow.
Two of the largest franchisees filed for bankruptcy in 2023. Meridian Restaurants Unlimited with 118 locations, and Tom's King with about 90 locations.
I want to move forward a little bit past the history. I want to share with y'all Restaurant Brands International, okay? Restaurant Brands International owns multiple different brands, but I want to break this down for y'all so y'all can make a more informed decision when you analyzing this information and you're trying to determine whether or not you want to invest in it.
14. It made RBI the third largest quick service company in the world, with combined same-store sales of $23 billion.
Going back to 2014, and we started to think about what other brands or what other segments of the quick service restaurant industry we might want to be involved in. And one of the really exciting segments is certainly breakfast and coffee. That's a really exciting segment, has great growth characteristics all around the world. And we came upon Tim Hortons. And as we learned more about it, we discovered it was an incredible business, an incredible brand, something that I really haven't seen almost anywhere else around the world.
Under the RBI umbrella, Burger King saw rapid expansion in the first 5 years. Over 3,400 stores were opened during that time, and revenue and shares were also rising.
Remember what I was telling y'all, growth. Companies are always looking to expand growth because that is the thing that shareholders want and analysts then use as a litmus to determine the health of a company. It's not just profitability, it's growth. Sometimes companies can grow too fast also. So when you see these companies swallowing up other companies, or they're not just adopting their technologies, they're just trying to grow really, really fast, that can also be a red flag also.
Revenues took a hit in 2017, then bounced back the following year. Initially, RBI's portfolio consisted of Burger King and Tim Hortons. Today, the company has expanded to a diverse lineup of quick service restaurants. I bet y'all didn't even know that Popeyes and Firehouse Subs. Some of y'all don't even have Firehouse Subs in y'all cities, I'm assuming. But I bet you didn't even know that Popeyes was owned by RBI.
I think one of the greatest things that we've been able to do with the brands that we've acquired is to make them more global brands. So we took Burger King, which was more focused in the US, and we grew it all around the world. And it's now much, much larger than it was when we acquired it. But also we've started to do that with some of the new brands. So Tim Hortons, which only had one international market, is now in dozens of countries around the world. And Popeyes is the same. So we've really been able to take a lot of these brands and make them truly global brands.
RBI RBI's portfolio straddles a couple of different segments. You have burgers, coffee, fried chicken, and now sub sandwiches. And then Burger King is like the most well-established brand, I would say, in terms of the US and internationally.
Right before the pandemic, Burger King accounted for nearly 70% of RBI's worldwide restaurants. But as the pandemic issued stay-at-home orders, BK's domestic chains took a significant hit. In fiscal year 2020, Burger King saw same-store sales drop nearly 8%. The company also saw a 28% uptick in drive-thru attendance, but wait times and menu options became a blind spot, as some
which is one of the things that make McDonald's unique. And it also makes Chick-fil-A unique, because whereas Chick-fil-A and McDonald's have been investing in their restaurants, and anybody that's been to a McDonald's drive-thru, or you've seen a McDonald's drive-thru, or you've seen a Chick-fil-A drive-thru, that's the thing that they specialize in. They had already been ahead of the curve, which was way before the pandemic, in which people are now prioritizing quicker response times and drive-thrus in order to be able to effectively get their food, right? When I seen McDonald's during the pandemic, and I seen that they were prepared and how people were really utilizing the drive-thrus once they start closing the inside of these restaurants, I was like, oh man, it was way ahead of the curve. They had been UXing and continuing to input technology to make things more efficient a long time ago. They didn't just have one line. You got the two lines and then you drive through. Yo, I've seen Chick-fil-A's have like 3 different lines, bro. And then Chick-fil-A also focuses on customer service. But my point is that when you see them trying to compete against people who are continuously innovating in that space, the restaurant space, it's hard. It's very, very hard for them to get a leg up or to continue to take share in what it is that people are looking for, because restaurant perception and also all the efficiencies that come along with implementing the technology is going to play a role in whether or not they can compete with a Wendy's or a McDonald's.
food offerings were complex to assemble, and single-lane drive-thrus caused congestion and longer wait times.
Burger King, coming off of a number of years of record sales and record profits, I think we lost our way a little bit. And when we came
Shout out to the black man with no
team
mustache
last year, recognizing what had been lost, I feel that it was loss of focus on who we are, what we do exceptionally well that makes us unique.
This is Chris Johnson. He's the founder and president of Raxon Restaurants.
I founded Raxon back in 2013. We started in Connecticut with 6 restaurants, and since we've grown to 65 restaurants operating in 7 states.
For franchisees, the effects of the pandemic wore on, signaling tighter margins for franchisees and lower profitability at chains.
We've seen a couple franchisee bankruptcies already this year, which is obviously not great for either the brand or its footprint.
The bankruptcy situations are just the process of getting restaurants into the right hands of the right franchisees with the right resources that can do what's necessary.
Basically, people that are invested in the success of the restaurant, they're not absentee owners. They have the capital and the resources to truly reinvest in, reinvent in what it is that they're doing as a individual restaurant. And they're going to be focused on truly driving growth and making sure that location is successful. That's long-term really what he's talking about, right? Do you got the money to really be able to invest in your restaurant? Do you have the time to truly dedicate and see this thing through? And then are you going to be an absentee owner or are you going to be a present owner? That's basically what he's saying. Through all of the different lingo and all of this other type of stuff from a C student's perspective, this is what they're communicating to you, okay?
Necessary to turn the brand around. And so in the short term, it's necessary just to go through the process to get those restaurants from the hands of one person into the hands of another person.
Can you sell?
While Burger King is closing down some 400 chains across the U.S., RBI plans to continue its expansion abroad.
They're also, looking to continue to expand internationally. But again, that's mostly through the opening of outlets versus in the US, they're having the opposite approach.
If you go back to 2010, we had about 5,000 restaurants outside of the US, and now we have more than 10,000. So we have really been able to grow tremendously around the world. Generally, in the international business, we work with a master franchise model where we'll have one partner that runs each of the countries. So we'll have a partner for Burger King in India, or Spain, or Mexico, or Brazil. And a lot of those businesses have been really successful.
Relatively flat same-store sales cause a concern and spark a needed revamp for the U.S. chains, even though international chains continued to perform well for RBI.
Overall, Burger King's numbers look great. It would just be when you looked at the domestic numbers versus the international numbers, there was a very clear, stark difference, especially as, lockdowns were easing and stores were reopening. You started to see Burger King US fall behind other US burger competitors, and its international stores weren't having the same problem.
Would I invest in RBI or Burger King? Absolutely not. That's really what this comes down to. Would I invest in it as me personally? I wouldn't. I'd want to see actual growth. I'd want to see same store sales continue to go up. I'd want to see better management, better leadership. I'd want to see them start to focus more singularly on the brand itself, on Burger King itself, instead of trying to divert all of their leadership over into all of these other brands all at the same time. And I think that they don't run it the same way that Yum Brands run everything that they have. Even Yum Brands combine different restaurants. You'll get a Taco Bell and a KFC literally at the same location. Would I invest in it personally? Absolutely not. I do think that McDonald's is a great company to invest in. Full disclosure, I am invested. I do have shares in McDonald's. I do think that they're an awesome company. I will probably continue to keep shares in McDonald's. I think that they're a phenomenally ran company. I think that they largely remove themselves from a lot of the different controversies and avoid all of the problems while they continue to innovate and bring value back to the shareholders. But I would not personally, at this point, invest in RBI, but I would invest in Yum Brands before. I would consider Yum before that. But more importantly, I would also invest in McDonald's before all of that. I am not a financial advisor. I'm not telling you what to do, but I am telling you what it is that I do in order to give you more insight and information as to how it is that you can leverage your portfolio and your resources in order to extract the most money possible. Okay?